Mike, how you doing?
I'm doing well. Ryan.
I'm glad you're on the show, man. You and I were sitting on a panel together a few months ago, and I've seen a lot of private equity guys giving presentations before, and you've got some unique experience that I want you to share with the owners from different family exposures family businesses that you've got, and then you're also in the private equity space. So I was excited to have you on the show because of how you explained your world, and then the second bite of the apple, which I've talked about and had different stories on. But for the listeners that aren't familiar with you or your company, maybe give us a little bit of background on how you got into private equity and then the company that you're working for.
Yeah, no, that sounds good. I'll give a really quick background on myself, kind of our firm and kind of my interest in this, and then we'll certainly cover the second bite of the apple and all that stuff. So real quick, I grew up in a small town, Dubuque, Iowa. It's about 50,000 people. I came up to Minneapolis to go to school at St. Thomas. I began my career originally as an investment banker at a firm called Goldsmith Agio Helms. They're now Lazard Middle Market. Great experience working with entrepreneurs and business owners. Lazard's full of just super smart, wonderful people. Lots of close relationships still. It was a great experience. My interest in private equity and how I got into the space came from a background with family business. So my grandparents were involved in a chain of shoe stores called Orange Shoes. In to give kind of context, on like 2002, they celebrated their 100th anniversary founding of the company in La Crosse. At its heyday, it was about 8 stores in Wisconsin and Iowa. And when I was working at an investment bank, I remember actually explaining to my grandmother what I did, and she just kind of looked bewildered, like, why didn't that exist when we were, going through our situation? And so ultimately I joined Stone Arch in the summer of 2008 after working 3 years as kind of a sell-side investment banker. Really interesting place in that, it's a Midwestern values-based private equity firm. We really view ourselves kind of almost as a, partnership private investment firm. We're taking an investment anywhere between 51 and 80% alongside the management team and founders or current shareholders, and just really great people. I spent a brief hiatus away to go get my MBA at Cornell University, then came back to Stone Arch, and I've done everything here. I've been, analyst through a director, so everything from, reviewing industries that our firm thinks is interesting, actually reviewing the individual investment opportunities. I'm negotiating the transactions, so that's, price, terms, et cetera. And then working with the management team over a 5 to 7 year kind of journey as we tackle problems and celebrate successes. It's been a great experience. Our firm, it's a really special place. We're involved in these transitional investments with owners, typically in the Midwest, which we tell people is kind of Ohio to Colorado to Missouri. And what we're good at and what separates us is that, a lot of owners want to preserve legacy and culture, and that for us is what we're trying to focus on is how do we preserve legacy and culture and help them get the business to the next level, still preserving, all those things that made it great, but living past, them, past the kind of, key man risk, if you will, that maybe the business holds today, where, all things flow through them to a better place that's, for all kind of stakeholders, both the employees who come to work every day, the families depend on those paychecks, the community, customers, vendors, that everybody has a better place. And in doing so, we generate value for the equity holders.
So, and I think that's awesome context. And then I want to kind of peel into that because sitting on the panel with you, I believe that you probably are doing those things. And I think, and that you probably, I'm curious if you agree or not, Mike, but like a lot of private equity firms say that, but it depends on where they get their money and what's actually driving the motives of buying the company, is so like we're, whether it's you guys or other firms, and how do you, where do you get your money and what is the goal of your firm? And, how do you align that up with that? And then what should the listeners and entrepreneurs what should they be asking or be concerned about as it relates to what you just said?
Yeah, it's interesting. So the private equity model, the traditional model is, our customers are our investors. And so, for our firm, that's, big institutions, they'll generally remain nameless, but it'd be universities you'd expect to see, and pension funds and endowments and things like that are giving us capital and they're looking at the asset class in general and saying, you've got to beat the industry average. We're targeting a top quartile return profile. Internally, we're basically saying, listen, we want kind of 20% plus returns. And we're taking a longer approach to it, kind of a 5 to 7 year view on our investments. There's other folks that take shorter term views or maybe have different investors. But, the private equity asset class has really matured from a cottage industry to now, a significant portion of the alternative space. And for most of the part, private equity firms are trying to grow the equity value by growing the company. Everybody has a different approach to doing it, depending on where it is in the life cycle or what their expertise is. I'm not sure if that answers your question, or if you
No, I
if you
think
want
it
to say
does
more
because
specific.
no, I think it does because and I think you worded it very interesting because not a lot of people realize that is the customers are your investors. And I think that's why when I've ever talked to anybody, it's like follow the money and find the motivation. And I think, what you'd said about, partnering up with, because now all of a sudden you're partnering up with companies and people and legacies and cultures. And so there's a lot of people to make happy and a lot of, expectations to be met. So how do you reconcile the two of trying to hit the cash on cash or the return that the people need, along with someone that has a specific way of running their company and they've hit a threshold or, a barrier that they haven't been able to break themselves?
Yeah, it's an interesting question. I mean, it's no different than, say, you're a college football coach. I mean, Nick Saban at Alabama is trying to win a national title every year, and he knows if he does so, his customers, which are ticket holders, will buy tickets. But he actually focuses on 17-year-old kids,
Mm-hmm.
and that's not totally different than us. We need to deliver returns and act in a fashion that represents our investors appropriately and ethically. And if we deliver top quartile returns, they'll continue to come back and new investors will knock on our door. Our approach and how we kind of execute against that is we focus on entrepreneurs and family business owners that have a view on their legacy and culture, and that they're likely the largest employer in their community, and selling to the Walmart, John Deere of their industry is just off the table. And because their social life is intertwined with work. I mean, there's a lot of gray there. And if they were to sell to a company that closes the facility, they've got to move. Their kids can't walk across the parking lot of high school without getting picked on because dad sold the business and closed the factory. So we know there are people out there that are looking for us, and we're looking for them, and basically saying, our angle and our the way we do this is partnership with people, and working together to tackle problems and to try to institutionalize a company and grow it, and by growing it, generate those returns for our investors. And part of that investor is our partner, the management team and shareholders that we are investing alongside. Every dollar we make, they make the same dollar. So, we're really working together so that we all do well.
Well, I think it's an interesting way of putting it too, because I think a lot of people run into that situation where it's their community, especially I know the Midwest, as you get into the rural areas. Yep. Where there's big manufacturers that, it's church, it's home, it's everywhere. The people that they're integrated with their companies is all over the place. So let's maybe, Mike, as we kind of go through the life cycle of the finding the company, the valuation, and then how that second bite is structured, because it's not an outright sale. So let's maybe start with the valuation and how you're going in there and finding and valuing these companies. Because I think there's this, especially with your values, as it sounds like, is how do you make sure that the owner gets what they deserve, but also knowing the fact that they've hit a threshold, right? So there's value that they have not been able to harvest themselves for various reasons, or there's a timeline or, inflection point that they've hit. So how do you get them what they want, and how do you perceive value in these companies, and what are you looking for?
Yeah, it's a challenge. In part because we're not a strategic buyer. We're not a multinational company that does what they do and can look at it and say, if it was put in inside our model, this is the cash it would kick out. And so to us, it's only worth the cash it generates and the cash it's going to generate in the foreseeable future, and then risk adjusted. And as a financial buyer, that's the only way we can look at it. is in terms of that. And so how I would tell an entrepreneur who's thinking about a private investor or a private equity firm, kind of view, is they should be looking at EBITDA, which you can Google. There's lots of information out there on what EBITDA is and how to calculate it. Certainly your accountant can help you through this. But EBITDA less capex, it's not true free cash flow, but it's in most people in private equity, we'd say, okay, that's the kind of free cash flow of your business. And in my experience, companies trading between kind of 4 and 12, 15 million of EBITDA, they generally fall somewhere between kind of 6 and 9 times that number. And what pushes it up or down one way or the other is going to be is risk. And so, an example like I was writing down is an oil field service company and a dental service, totally different businesses, right? Oil field service, good business, but we all know it's going to cycle, and when it does, it's going to cycle hard. Project based, you punch a hole in the ground. You don't continuously punch holes in the ground. You punch one hole in the ground, then you move on. You punch another hole in the ground. You've got a big customer could be 30 to 75% of revenue. Those companies trade on the lower side of that range because of a number of perceived risk factors to continued free cash flow into the future. Where a dental service business, dental practice might have a big customer might be 1% of revenue or less, and it's predictable. You have to go back every year and get your teeth cleaned. And so depending on the risk factors associated with the cash that's coming next year, you trade on one side or the other of that range. There's certainly companies that trade above and below that range. I just shared. It's by no means a complete picture, but it's a 80-20 rule, I guess.
So, and I think you put it in a very clear way. And so when you're looking, let's say, you got these people that family run businesses, or it's one or single, I'm assuming they're not VC backed. A lot of the people that you're going for, right? It's a lot of people that have, carried the risk and have done and built this business that's integrated in their family, their community, might have a couple partners. How well are they running these to come in where and where do you meet in the middle? If what I'm saying is makes sense, is in they've gotten to a certain point and then there's a lot of value that you can help create. So how are you going in there making sure, because a lot of people I think perceive private equity, they're coming in there with real estate investors, they're going to flip it, right? They're going to find all of our weaknesses, they're going to exploit them and then do all their tactics. How do you reconcile that with the legacy and all the other, like you said, the real human parts of that, and then also getting the value that you need to go forward?
Yeah. So a couple of thoughts. One, for us, when we make an investment, we tell people to call our prior partners. Hey, call the companies we partnered with in the past and ask them how we've operated in the good and the bad, and ask them how we operated in 08, 09. And so that's key. And most people, when they're going through this process where they're talking to a private equity firm, at a certain point, they should do that. Kind of around LOI timeframe. If you get an LOI and you should be asking, can I talk to 2 or 3 guys or even more? Can I talk to everybody? And so that's important. If you think about what that means, though, it means that if we can't operate like we're building a pirate ship, because we need positive references. So we need the experience to go well for the people we're partnering with, both financially, but as well as, during the time that we're partners. So all that's kind of running in the back of our mind is our future success is dependent on how we treat people. So that's part of it. The second piece is economically, we tie ourselves to our partners. So if we come in and buy 60% of a business and the founding family owns 40%, how we're different than, say, a real estate investor, flipping a house, because we're not buying 100% of the house from them and then flipping it and selling it to make a profit. We're partnering with them and saying, together, these are the things that if we do, these levers that we pull, the company will be worth more, and it's worth more for us and for you.
Mm-hmm. So and I think that's a great way to put it. And let's peel that back a little bit on how, getting to the value and getting to the different spectrum of how you come to that 60-40, or like you said, 51 to 80%, let's literally to get into the deal structure, because you're mainly not going into the outright sale. And so what are some of the reasons that someone would go your route or a private equity route, and how do they get to the determination of how much money should they get up front or over time? How do you structure it? And then getting to that percentages, and then what the relationship looks like going forward.
Yeah. So there's a lot of kind of personal, intangible, strategic reasons that someone should think about a private equity firm, I would say if legacy and culture are important to you, private equity is worth exploring. If your team's important to you and you want to give them a shot at making, kind of real life-changing money, private equity is interesting. If long-term financial planning is important to you, and I'd encourage people to talk to their wealth advisor, there's lots of really sophisticated techniques, trust, grats, clats, et cetera. Private equity is interesting. You might ultimately choose a different path, but you should at least, consult with several of your advisors, your accountant, lawyer, and a lawyer who does M&A. And, they would have an M&A department, or they would have, several deals that they've done, and a wealth manager. And a wealth manager, again, that's not your insurance salesman, that's an actual wealth manager. But talking to those people about what's private equity like and should I do it? Assuming that those things are interesting to you, assuming that you probably have over 3 million of EBITDA, there is a private equity firm out there for you. You just have to find them. And I don't know if that answered your question as far as is private equity, what attributes, do you have if the asset class is interesting? And then certainly happy to talk about,
Well, I think you answered it, and then it's also like maybe expanding on because they can't just walk away, right? And I think maybe
Yep.
giving your perception
Correct.
of like, I think a lot of people going, oh, I'm done, right? And
Yeah.
so like by that time, okay, you might have to sell to Walmart and gut your company and move. And so there's like these different levers that you can't have everything, right? And it depends on how well your company's run. So when you guys come in there, what is the other additional intangibles of like partnering up with you guys and what you guys should expect from the owner, the management team, then and going forward, and then we can kind of dive into like actually how you're structuring the deal of the deal.
Yeah. I want to make sure I caught that. So what do you want me to answer first?
So about I think maybe just of your exposure of when you're sitting down and talking to whether they've been clients of yours or not, or what you've seen, Mike, of the mentality of like the owner's going to have to probably still continue to work, right? You're relying and like your expectations of them and their team.
Sure. So I'd say this: at the heart of disappointment lies expectations. And when we're looking to make a partnership with somebody, it doesn't have to be that they're day-to-day CEO forever. We likely don't have anybody on our staff, nor does the company have somebody who could be the CEO on Monday morning if we close on Friday. Because if they did, they may not have this issue and need to talk to us. Our model is partnering with people, not running their business for them. And so we don't have the person on staff. So before we end up wiring, funds and we're, spending kind of, 60 to 90 days together, going through diligence, we're having that discussion about expectations. What are you looking for over the next, 5 to 7 years? Likely you picked us because you're looking to get out. People generally pick us for one of kind of three reasons. They're either a management team trying to buy out an absentee owner. They don't have the money. They're a person in their 60s or 70s that wants to retire, and their kids aren't going to be 45 and ready to run the business anytime soon, or maybe the light switch isn't on, and so they're what am I going to do? Or they're a 50-year-old business owner that sees something on the horizon they want to pull off, and they just can't take on the risk of doing it, buying a competitor or buying into adjacent market, what have you. In any of those three, we're having a discussion about expectations over the next couple of years together. And oftentimes people are saying, I'm picking you because I want to retire while knowing that this company's in a good spot on the other side of my involvement, and that I kind of have a big say in who the next management team is or
Mm-hmm.
the next person in charge.
Mm-hmm.
So we get involved in that conversation up front. How long do you want to be the day-to-day CEO? That might be 6 months. That could be 3 years. That could be 4 years. And in some instances, it was, I want to be the CEO the whole time. And then on the other side of it, they said, gosh, without having this 800-pound sumo wrestler sleeping on my chest every night, I actually really, I really like this. And I'm going to keep reloading and go private equity to private equity firm and keep getting bigger. And I'll keep rolling my 20% and do well. So we've seen everything, and certainly people can change their minds. We need a plan. And so we spend some time up front talking about what's that plan, what's the next 5 years look like, when do you want to start to dial it back, and then we build a relationship with the person so that we're talking regularly if something changes or accelerates or slows down, that they just tell us.
Well, and where do you see, like, as in, I think bucketing those three helps a lot of clarity. I think I think, how do you start and meet and get on the same page with the owner's vision? So I think the retired or the person that kind of wants to sunset over a period of time, I think obviously the private equity partners mentality and what they want and what, once they get comfortable with you and your vision, then it's like, okay, I'm going to kind of unwind here. But like, let's say that there's an owner that also has some of these bigger aspirations, you know, do these different structures or these different visions impact how you structure the deal and how much they roll and
Oh
how?
yeah, yeah. Great question. No, they certainly can. So, somebody who's saying, "Gosh, I want to buy two competitors and open some new locations. I want to do all these things, but I don't want to take on as much risk." They're sitting down with their wealth manager and they're talking about how much is enough to put behind the fence, and then how much is risk appetite. Most likely, their wealth managers thrilled because they want to put something behind the fence and not keep it all at risk every day. But for those people, maybe they keep a little bit more in, as far as a ownership percentage, where the person who's 70 and thinks, gosh, I should have done this 15 years ago. They might be looking more at, like, grandkids trusts are really what they're rolling. Hey, I'm going to roll 10%. I've worked with my wealth manager and lawyer to set up a bunch of grats and clats and stuff like that. So maybe it's some philanthropy I'm going to do is really what the equity role is, and like legacy stuff. But the I want most of the cash now so that my wife and I, or my husband and I, whatever it is, we can start to think about retiring and really dialing back. And then in that situation, the expectation might be day to day 6 months, maybe a little bit longer if it takes us longer to promote somebody internally or hire somebody. But as soon as we get a capable CEO in here, I really want to become an active board member. We just try to figure all that out up front, and frankly, we just have pretty candid conversations with people. We're we're pretty agreeable people, and we're nice and friendly, and maybe our peers in some of the bigger cities are kind of harder to have that conversation with. But for us, we just ask them.
And that makes a ton of sense, right? I mean, almost too much sense, right? um, so how about, what challenges do you see for an entrepreneur? Like, let's say one of our listeners is sitting down in front of you, and they want to buy two of their competitors and want to do all these things, they got all these aspirations. How do you guys get on the same page with that vision? So, because I think, I mean, obviously you're coming in, and this can maybe dovetail into the deal structure, but you guys are buying controlling interest. So, which
Yep.
I think there's this fear, okay, now you're literally an employee, you're an investor side by side, but they're an employee. So the changing
Yep.
of the vision and the management team and who you hire, and they've got a lot of people to talk about that stuff with instead of just pulling the gun and just doing whatever they want. So how do you get to a point, and what should the owners be concerned about, or what should they do to make sure that the vision is extremely clear and understanding their role in that decision process going forward?
Yeah, I mean, it doesn't just happen. I mean, it's very rare that we knock on somebody's door, they knock on our door, and 3 months later we're partners. Um, so there's a lot of discussion and back and forth. For us, we don't believe that we have all the best ideas. We've got a really big network, and we think we're pretty good decision makers. But really our expertise is seeing business models that seem to show back up in different industries and the same challenges and opportunities, and being familiar with those, and then having a really big network and being wise enough to draw on that network and bring in a subject matter expert to solve some problem. And that's kind of what we're trying to do. So when someone comes into us and says, hey, I own a flexible packaging business and I want to acquire three of my competitors and get into this adjacent market, and here's why, we'll listen to that and ask them lots of questions about why they think that would work and what's going on in the market, et cetera. And then after that meeting, the group of us, we're picking up the phone and we're talking to people who are experts in packaging and saying, hey, we just met with this great family, and they were talking about this business, and here's some of the stuff they're thinking about doing. So there's no names that are exchanged, but we're saying, hey, we're trying to basically stress test with
Mm-hmm.
people that know what they're doing. Is what we heard real, and is this interesting? And then we're then circling back. So we draw on our network to verify ideas, and also to then come back and say, hey, we ran the traps on what you were saying. Everybody's saying that those, two things you want to do that you should be doing, but this third idea kept coming up. What do you think of that? And then we shut up and we listen.
Yeah, because if you're going to be making decisions together, that it's a natural process, that makes sense, right? And I'm assuming, just like any other partnership, if you get someone that doesn't listen and is used to being, the dictator, it's not going to be overly advantageous to partner up.
Yeah, the Hugo Chavez partnership doesn't work, right?
So, let's say you kind of have someone, like, maybe let's pick a random example of whether that someone wants to unwind, or maybe somewhere in between there where they want to accomplish a couple of things and then unwind. So let's talk into the second bite, because I think a lot of people talk about it but don't necessarily get it. And you explained in the panel that I saw, and you explained it very well on how that works. So I don't know, maybe I'll just kind of tee it up and say, okay, like, how is the deal structured, and then how does that work?
So I wrestled with how to walk through this, and I was trying to think about, is a house analogy good with a mortgage, or talk about a business? And the house is easier to talk about. Think about, like, you're buying a house with some people and you're going to rent it out. But I thought it doesn't give it any personality. So I'm going to try my best to give an example. We'll use some numbers, and so I'd encourage your listeners to rewind if they need to and make notes. And there's going to be a little bit of math.
If you're willing to give some of the, a couple of those graphs or something like that, I could throw those in the show notes for the listeners.
Sure. Yeah, sure. I certainly can. So there's going to be a little bit of math, and some people grab your pens and pencils. But so we've got a business owner, we'll call her Wendy. And Wendy is a second generation family business owner, and she's deciding what to do with her business. Her company does 30 million of revenue and 5 of EBITDA. So EBITDA margins solidly in the mid-teens. And her company makes fire hydrants, right? So we were not going to do widgets and have some random company name. So Wendy's business, fire hydrant business, 5 million of EBITDA. So Wendy's had kids later in her life. She's in her 50s. They're in middle school. They're not going to turn 40 anytime soon to take over. She sees lots of opportunity on the horizon. She'd like to expand into making other metal valves, maybe acquire one of her friends' businesses from different trade shows that she's gotten to know that's at a different point in her life. And she's trying to figure out, what do I do? So we meet Wendy, and we think she's great. Her team's super hardworking. She's honest. There's great people on her team. She sees her employees as her extended family. So we negotiate a deal with Wendy, and we're going to be her partner. And so the deal we strike is we're going to buy 60% of the company. So the price we agree on, and this is for easy math so everyone can follow. So we agree on a 5 times EBITDA valuation of $25 million. So EBITDA is 5 times 25. So we, Stone Arch, we coordinate with a lender. We go to the bank, and we get a 3 times EBITDA loan. So we get a loan for $15 million.
Can I put a pause there, because this is good, and I love the context. So explain to the listeners a lender, because I think there's all this. Yeah. There's less exposure for owners, because they're normally dealing with the up and down the street bankers who may or may not be friends or enemies. And so who are you guys dealing? Where does this loan for that chunk of money come from?
So there's generally 2 places that loan comes from. It comes from either a depository institution, so U.S. Bank, CIBC, First Merchants. Somebody who's a bank that the people would know, Wells Fargo, et cetera. Or it's coming from a fund, and there's lots of senior capital funds that exist. Madison Capital Funding would be one, Monroe. There's a number of others. There's lots of others. So that's who's generally coming up that we're going to and saying, we like this business. Here's why. There's lender packages, et cetera. And we work with them, and we get a loan. What's really unique about all this is that Wendy no longer personally guarantees that debt. So when most business owners are looking at debt and it's scary, it's often because they're personally guaranteeing it. So they would look at it like, yeah, I get $15 million, but I have to guarantee it. So why do I want the risk? With us, they don't personally guarantee it anymore.
Well, and it's interesting too, because there's an underwriting process right here, right?
Yep.
And so now, what the listener should really take away is, this is why the risk of the cash flow is so important, because there's a lot of people taking a lot of bets on it.
Yeah, so the lender is going to go through a significant process where they're looking at the same thing we are, kind of risk to cash. Now they don't care as much about growth. They're looking at I'm going to loan you this money at this interest rate and I want it back. Where for us, we're saying we're gonna put this money in, and if all we do is get it back, that's a nightmare for us. So we need to see it. We need to see that equity grow, 2, 3 times. And the only real way for that to happen in a meaningful way is to grow the business. And I'll walk through kind of why that is a little bit later. But
Hmm.
the underwriting process of the lender, how do they get the money back? For us, the underwriting process is risk adjusted cash flow, but also growth.
Okay, so awesome detour. I think it was relevant. But so let's go back to, so you go back and you're working with the lender.
Yeah, so we're working with a lender to get a loan lined up for Winnie's business. They're comfortable at 3 times EBITDA or $15 million. So if people are looking at the numbers they're writing down in front of them, it's value of the company 25, the loan that we can get 15, and so that delta is 10 million of equity that needs to come up with. Now we want to buy 60% of the business from Wendy, so we need to come up with 6 million of cash from our fund. And so what Wendy's going to receive is 15 million from the kind of levered recap of the business and 6 million of equity from us coming in. So she's going to get $21 million and still own 40% of the company.
Hmm.
Because of the leverage that's on there, the debt, she's able to take 21 of the 25, which is 84% for the viewers at home of the total value, and still keep 40% of the equity. And that's what's unique about our firm.
So the difference between that and taking the 4 million off, right? And I think this is where really understanding what they want and why. So if she wants to continue doing this, so she's rolling $4 million versus going and selling to someone else that'll give her a check for potentially $28 million
Yep,
for a strategic
absolutely.
buyer. So like,
Yep.
why would they roll that money in when they could potentially do something else?
Yeah, and so this goes back to their own personal situation. Do I have a desire to stay around? Do I have a desire to take care of and be part of, deciding how the future of this, kind of company moves forward, strategy, who's going to run it? Do I see something on the horizon? Do I actually want an involvement in it as a board member or an executive still? All those questions are going to influence, if you take the 25 or 28, as you kind of said with the strategic buyer, or a little bit, the 25 valuation, but 21 of cash from us.
Mm-hmm.
Somebody has to make that decision. We can't make it for them, because you can't go back. I mean, once you go through it and you do it, you can't go backwards.
Yeah. So now that you've got that structure and they've rolled $4 million, explain how the bank gets paid, how you hit your numbers, how they could potentially, how the second bite actually works. Because I can't remember how you articulated it, Mike, but
Yeah.
there's only a couple levers that you can pull for everybody to hit their goals.
Yeah, there's 3 levers that we can pull in as a private equity firm, and how you pull those levers. There's infinite numbers to pull them, but you can grow the company, you can grow the multiple, and you can pay down debt. That's it. Those are the 3 things you can do. And if you to walk through really quickly, so if 5 million of EBITDA at a 5 times multiple is 25, and you can grow the business to 6 million of EBITDA, and sell for 5 times, you created 5 million of value.
Mm-hmm.
How would we go about growing a business? So people are always going to ask, okay, well, that's the lever, but okay, you can't just write it on a PowerPoint and say it's true. How do you actually grow a business? Um, you know, a lever we might pull is bringing in a sales manager. So not a salesperson, but an actual sales manager, or helping assist with the hiring of great salespeople, helping even know the right person to bring in to interview salespeople, to weed through charlatans from real salespeople. I think most business people appreciate that there's a lot of really bad salespeople out there that market themselves as good salespeople, and it's hard to tell in just an interview if they're any good at it or not. There's lots of tests that they can take to actually demonstrate, do they have any idea what they're doing. Giving people professional training, even knowing the right person to bring in to offer training. Possible rebranding effort, marketing dollars spent wisely, developing new product development processes. We leverage a lot of resources in our network to help them develop and execute on plans that we come up with our partners. Much like you use an accountant to help you with your books. We've got an expert in all sorts of functional areas that we can bring in to help us partner, develop, and execute a plan.
Mm-hmm.
So that's one lever. We can grow the business. The second one is grow the multiple. And that's typically done by removing risk. So that a deeper management team, great systems, so CRM, financial system, KPIs, reporting, a sales team versus an owner operator that's, being the salesperson, a chief operating officer, doing all those things themselves, having a real team, helping think about, growth. Are we going to grow, towards our existing customer base? Certainly we don't want to turn down, money coming to us, but active business development efforts away from industry concentrations, removing customer concentrations, right? Hiring salespeople and saying, bang the phones and find us additional customers. Because if we can pull customer concentration and industry concentrations down,
Mm-hmm.
the company has less risk and the multiple goes up. So that's the second one. And the same math would apply, right? A 5 million of EBITDA, but with less risk might trade at 6 times instead of 5 times. And, there's 5 million of value that just showed up.
Mm-hmm.
And then the third one is paying down debt. And so, when earlier in this call, I talked about EBITDA less CapEx, and that number is essentially cash flow that can be used to service debt. And, for us, we're looking to generally pay off half the loan in about a 5-year period. And so that $15 million loan over 5 years being, paid down in half, that creates an extra kind of $7.5 million of equity value. And so, there's a lot of value to pulling all three of those levers at the same time.
Well, I was just going to say, and then you pull them all at the same time and like magic happens. I mean, that's
because they're interrelated. I mean, that's the best part about our job is that if you grow a company, you hire great people, typically all three of these levers get pulled. And if you just walk through the math really quick, so 5 million of EBITDA and a 5 times value is $25 million. And, that $15 million loan is how we're getting there. So the owner is getting 21 million today and retains 40% of the company. So we pull all three levers. We grow EBITDA to 6 from 5. We increase the multiple from 5 to 6 because we add management depth and systems and reporting and new customers. We can basically answer questions when people are diligencing the business. And then we pay off half the loan. So now there's only 7.5 million of debt remaining, not 15. If we do all three of those things, the enterprise value of the business is no longer 25. Now it's 36, and we only have 7.5 of debt on the books. So we got 28.5 of equity. Wendy with her fire hydrant business owns 40% of that. So she gets a second check for $11.4 million. So all in, Wendy takes home $32 million over 5 years, and her fingerprints are all over who's the next CEO, where's the direction of the company, all those things. And financially she wins. Which
I'd say that's a pretty good return.
Yeah.
Which is why you do it, which is why they should.
Yeah, that's. I mean, if it all works, that's how it works.
Well, and that's why I was excited to have you on the show, because how you articulated this, Mike. I mean, like, I've interviewed a lot of people, and I know a lot of people in our space, and there's not as many people that clearly say. I mean, it really boils it down to this, and I think it's just interesting because owners need to look at this stuff anyways, and like it's just it's really only these three things. So one of the questions are going to come from the context of one of these three areas. That's why you're going to be doing certain things. Couple other random questions about this stuff is like, one is, how do you, because I think, you had mentioned at the beginning or towards the beginning about executive teams. So how do you integrate? So for example, I mean, honestly, I think about this, and I think you and I talked about it, where like we were ripe for a situation like yours, but instead we sold it outright to a third party and had all the things happen that I wish I wouldn't have, right? Whereas in like, but it was like, well, I don't have enough money, because it's my dad's cash flow. And so it was like this whole question, and like, how do you get executives who are crucial to the business into this mix, and to give them, you had said them, to have them create substantial wealth, or to eventually get teed up to buy it?
Yeah. So the management teams that, their wealth creation event is, when we're doing a deal, all of those individuals generally have the opportunity to put cash in, to buy into the business as kind of hard equity. And then secondly, we put in, so we generally like LLCs versus C Corps. And so it's not a stock option plan because that's only relevant for a C corp, but it's a unit appreciation plan. We generally have a unit appreciation plan in place for motivating management team members to think about the business in the shower.
Can
Think
you
about the
explain that?
business.
Can you
Yeah, think
explain?
about this like an owner. Okay, so yeah, unit appreciation plan basically means we put a percentage of the business up for grabs based on hurdles for people like the CFO, head of sales, chief operating officer, maybe the president if we hire or promote somebody. All those people have a chance to own a piece of the business, and that ownership vests. So let's just assume there's a 5% unit appreciation plan. So 5% of the company is up for grabs. And if you think about what that means in my example with Windy, with $7.5 million of debt on the books, 5% of 28.5 at that end of that deal is possibly up for grabs for
Mm-hmm.
the couple of those people. So that's real money,
Mm-hmm.
for somebody who might be used to making 180 grand to get a check for a couple 100,000
Yep.
and then that cash can be used if we're selling our ownership to another private equity firm to roll into the next deal. And so for some of these people, there's an opportunity to continue to roll proceeds and realize either deal bonuses or kind of stock option plans or unit appreciation plans, and continue to roll that cash into equity as the company goes through new partnerships.
So when you're an owner listening to this, what would you say to someone that says, well, hell with it, I'm just going to do all this stuff myself? What would
Yeah.
be the difference between them and someone that would be a good candidate?
Well, listen, I trade on goodwill. So I meet with a lot of people and spend time talking to people about their business and what they're looking to do and a challenge they're facing, and I might point them in a direction that's not our firm, because I want to create goodwill so that they give us as a reference or refer us to somebody. There's a lot of business owners that go on hunting and skiing trips and hear from another friend, Bobby and Jenny don't want to take over the metal fab business.
Mm-hmm.
So if I can help somebody think through something and be happy and treat them fairly, potentially they'll refer, that hunting buddy to me and say, hey, you should meet this guy, Mike O'Neill. He shot us straight, helped us out. So I would generally tell somebody, yeah, you should try to do all this stuff on your own if you can. What stops people from doing it is risk. So imagine you own a business and you have some salespeople, but they just kind of make phone calls and they're more business development. They're not out, meeting with 30% of your revenue every day. And the risk that an owner has in having that salesperson out there is that if that salesperson steps on their tie and really screws up, they just have to go interview for a new job. And they can paint any picture and tell any story about why it didn't work out. But the owner has to figure out, okay, I just lost 30% of revenue. My profits just got crushed. And there's all these families that depend on this paycheck. How am I going to make this work? Right. So that's the risk. Now, the opportunity for them is if they hire those kind of salespeople, they might triple the size of the business and be on the other side of that conversation. Gosh, I'm doing great. I have all this cash to hire, really smart people to help me out with this, because I hired these salespeople that can go, generate sales. So for us, I look at it like not having salespeople is risk. But for them, they'd say having salespeople is risk. Depending on where you sit, some things sound terrifying and other things sound exciting.
It just depends on whether that they want that 800-pound sumo
wrestler that sleeps on their chest every night. Yeah.
Hey, do you want a toddler and having the sumo wrestler sitting next to you, or do you want right?
Exactly.
How strong is your chest?
Exactly.
Man, I really enjoyed it, and I love how you kind of walk through all this stuff. If the listeners want more information, we'll try and put some of the stuff in the show notes. But if they want to get in touch with you, want more information, what's the best way to get in touch with you?
Yeah, so I'm on LinkedIn, Michael O'Neill, Minneapolis, Minnesota, and you certainly can find me. My contact information's on there. You can send me an email at my Stone Arch email, which is moneil@stonearchcapital.com. You can email me on my Cornell email. You can contact me and just say, I'm thinking about something, or I want to bounce an idea off somebody, or who should I go meet with or speak to. We trade in goodwill, and so we're trying to regularly help people out so that the right opportunity presents itself to us, because we don't need to make a ton of investments. We just need to make the right ones.
Mike, I really enjoyed having you on the show, man.
Absolutely. Well, I appreciate it, Ryan. Thank you so much, and best of luck, everybody, as you're thinking this through. It's a big decision, and so it's not to be taken lightly. And just the more information you get, the better prepared you are.
Yeah, I think well said. And I normally I actually forgot is like, what is the one thing if you were to leave the listeners with it, and I think you kind of just did, but like if there's one thing that, because we talked about a lot, if you maybe highlight something, or if it's something that we didn't talk about, what would be the one thing that you'd kind of leave them with?
It's putting together the right group of advisors. You probably have a buddy who's your attorney that maybe you were a fraternity brother with, or sorority sister with. And it's not to say that they are ever going to lose the business, but you should have an attorney who's very, very well versed in M&A, whether they have a M&A, division inside their law firm, or, and Ryan, that's how we met. We met because there's a boutique law firm in town, but they're very, very versed in M&A. And so, folks like that would be, people to talk to. Those people, then your accountant, your tax, and as well as your audit person, your tax person, because they're going to help you be able to think about some of this stuff, and then a wealth manager. And you want people to communicate with one another. The more that you silo everyone off and don't let them talk and know, the worse information and advice they can give you. And so frankly, you'd call a meeting and have your attorney there, and your accountant there, and your wealth manager there, and say, I'm thinking about exploring my alternatives. Tell me more about private equity, or tell me about what I should think about doing. And they're going to be able to provide you with advice. And having them disagree in front of you is probably a good thing, right? Having them, give the pros and cons of all the different options.
Well said. And yeah, which is, you've been there, done that, seen it. And then you hit on a bunch of good, very, very good points. Well, yeah. I really appreciate it, Mike. I really enjoyed it.
Sounds good, Ryan. Appreciate it. And thank you much.